Ooh, almost knocked over the mic. All right, everybody, let's get straight into it. This is going to be our intro into the foreign exchange or Forex markets. Oh, too far. All right, so first we're going to go over a few terms and definitions. Let me move my face. Handsome his face out the way. Going to go over a few terms and definitions just to get us a little bit familiar with the terminology that we're going to be using in this presentation. So first being exchange rate. So exchange rate is the value of one currency for the purpose of conversion to another. Foreign exchange market is going to be the global financial market that allows one to exchange national currencies. Forex is short just for the foreign exchange market, or foreign exchange in short. The exchange rate pair or currency pair is a quotation of two different currencies with the value of one being quoted against another. Currency exchange is the action of actually exchanging one currency for another. The base currency is going to be the first currency you see in a currency pair, and the quote currency is going to be the second currency that you see in a currency pair. All right. So what is Forex? Forex is short for foreign exchange market, which is simply just the global financial market that allows people to exchange one currency for another. Now, currencies are traded against one another as exchange rate pairs that also referred to as currency pairs. For example, Euro USD, which is a major currency pair trading the euro versus the US dollar. Now, the exchange rate for Euro USD is 1.1156, which entails just telling us that 1 euro is worth 1.11 US dollars. And we'll expand on this later on as we go on. So compared to the $22.4 billion a day in trading volume of the New York Stock Exchange, the foreign exchange market actually trades at a whopping $6.6 trillion a day, making it the largest financial market in the world. Now, the Forex market is open and available 24 hours a day in different parts of the world, just based on different time zones. But essentially, it is able to be traded from 5 p.m. Eastern on Sunday until 4 p.m. Eastern on Friday. Availability, like I said, to a trade, 24 hours, depending on where you're located in the world. Now, foreign exchange market example. So let's just say you're from the United States, or maybe you've taken a trip from the United States to Italy or Europe. And when you get in the airport, you realize that you no longer have the currency for the country that you're in, right? So you find this big kiosk in the airport, says currency exchange. You go to the currency exchange. You give them $500, right? You're like, hey, I need to exchange this $500 in US and I need to get euros. So they're going to tell you the exchange rate is at that time 0.9000, which entails just means that every US dollar is going to get you 0.9 euros, right? So you exchange your $500 in US and you get about 450 euros back in return. So after your trip, you return back to the States, realize you still got some leftover cash. You got about 225 euros, so a little bit over half the amount, or half in exactly the amount that you started with. So you go once again, find your nearest currency exchange. You go back to the currency exchange. You hand them the euros, like, hey, I need US dollars. They exchange the money. You get back $260. Now, this is about $10 more than you thought you would have. You try to give back the money, and they tell you, hey, no, you're good. The exchange rate has changed. And essentially, this is how we profit in the foreign exchange market. We profit off of the difference in exchange rate in these currency pairs. Now, what are we trading when we are trading Forex? In the simplest answer, what we're trading is money. But to be more specifically, we're trading the difference in the exchange rate, right? We're making educated, speculated guesses on if let's just say Euro USD, right? We essentially are making educated guesses on if the euro is going to go up in value compared to its counterpart, the US dollar. So we're trading the strength or weaknesses of these different currencies versus one another, because we know based off supply and demand, whichever one is more valued at the time, the value of said currency will increase. So in Forex, let's just say you want to buy into US USD, right? You want to go long, you want to buy into USD CAD. Essentially what you're doing is speculating that the US dollar is going to increase in value compared to the Canadian dollar, right? And if you so happen to be correct, once price does move up, that exchange rate moves up. This is how we profit in the foreign exchange market, because now we're able to sell, the currency, that pair, that trade back to the market for a profit, right? So in general, the exchange rate of a currency versus other currencies is a reflection of the condition of their economy versus the economy that they're traded against. So in Forex, we are able to buy and sell currencies, essentially making this a recession-proof financial market, because we're speculating which currency is going to do better or worse, and there's always going to be one that's doing better or worse than the other. So putting it all together, now that we know that we are now trading the foreign exchange markets, which is the market that allows you to trade different currencies from different nations against one another. These currencies are quoted in pairs called exchange rate pairs or currency pairs, and these pairs are assigned a value on what it will cost to exchange one currency for another currency, right? And what we're doing is trading a value of this exchange rate based on if we think the price is going to go up or going to go down. And that essentially is how we are making money in the Forex exchange market. So that's all we got for this video. I'm going to see y'all in the next one.